Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome to Galaxy Brains.
Thanks for having me.
We had some interesting stuff has been happening. I guess that's no surprise. Markets are always interesting. But in Jackson Hole last week, the Federal Reserve Chairman, Jay Powell, gave a speech. He seemed to very clearly confirm that the Fed is now more focused on its employment mandate than worried about combating inflation, which seemed like a green light now for rate cuts.
Yeah, no, absolutely. He basically reinforced the expectations for the Fed to cut pretty aggressively over the course of the next year. You had, fixed income rally on the back of his speech, dollar sell off. And so, I think none of what he said really came as a surprise to the market. And in all honesty, you're basically at the point where the Fed recognizes the fact that monetary policy has been restrictive for a long period of time, and that restrictiveness is beginning to impact the labor market. In addition, that restrictiveness may not be warranted with respect to the price level or the rate of change of the price level. And so with that in mind, you probably need to be at neutral sooner rather than later. And what's neutral? Well, let's say 2.5% is neutral. So one could argue that you are, almost 300 basis points away from being at a neutral level of interest rates. And we define a neutral level of interest rates as, a level of interest rates that neither encourages more economic activity nor discourages it. From like an aggregate demand and supply standpoint. And so, that happy equilibrium place. And
so we're 300 basis points above that right now.
Yes.
And so that's theoretically 12 cuts, quote unquote.
Yeah.
So that's a fairly large amount of cutting from where we are.
Yeah, one could argue that that's where we need to be.
And
the other argument, though, is the neutral rate is now higher.
Yeah.
And so is neutral 3.5? But
they don't actually have to decide that yet. They can start cutting, and then the question is, where do they stop cutting
to
decide that?
Correct. Yeah. And the question is, at what pace should they cut?
But so pace is the magnitude of each cut.
Yes.
But do we expect, and I think I've looked at this chart, historically when they start a cutting cycle or regime, it's a little staircase, right? They take off either 25 or 50 or some amount.
Normally 50.
Basically every time.
Yeah.
For until they get to where they want.
Or it's a dramatic situation and it's like an emergency cut.
True, but
like 100 basis
we don't
points.
think we're there, right?
Yeah.
So we're likely to see either 25 or 50 bips cuts multiple times in a row starting in September. That's what the market basically thinks
so
now.
you now have 100 basis points priced in for the next 3 meetings. So that's a little over 25 per meeting.
Yeah.
And
so that's like 150 and 225s or something is the expectation.
And then you have about 195 basis points out to the June 15 meeting in 2025. So that's a lot of cutting.
Yep.
Basically just going in 25.
Every single time.
Yes.
Yeah. So it is. It's the play. The expectation is the staircase down, basically. Yeah.
But that's absent any kind of shocks.
Totally. They could pause or do more. Right.
Yeah. And in theory, it's like if you start to see the unemployment rate ticking meaningfully higher,
cut faster?
You should cut faster.
Yeah.
And there's nothing to tell you that you shouldn't because the price pressures have gone away.
Right.
Right.
And if inflation stays down, may as well come down.
May as well come down. I mean, the cost of goods have been coming down. Oil's had some rebounds because of, geopolitical risks, et cetera, but that's broadly been coming down. The supply side stuff as a function of COVID has, completely abated.
Okay, so there's no longer the lines of millions of truckers unable to get into the port and stuff.
Correct.
The logistics have eased.
Have totally eased.
Great.
Fully normalized. And where we've seen the most kind of pressure has been in the services and housing. And, you're starting to see some cooling there.
Yeah.
And
you think what's going to happen? What is the expectation for the housing market? If rates come down. I mean, right? Presumably, the cost of mortgages comes down, right? But
housing affordability will improve.
But
in
won't
theory?
It? Yes.
However, it's a little bit trickier. One, it's real estate is very local. So it's dependent on
That's true.
what market you're in.
Right.
If you're in Austin, Texas these days, it's not so good. And even
Well,
if
it's a buyer's market down there.
yes,
Yeah.
even if the mortgage rates come down, right, like it's not going to impact things too much. And then if you're in an area where the supply of homes is still super tight, right, then the prices of homes might not
The
change
mortgage
that much.
Yeah, the borrow cost might come down, but the prices
price
may
of the
not,
home,
and the
correct.
competition may not.
Correct.
Because that's one of the other things. I mean, this is just purely I'm total layman when it comes to the housing market, but if the cost to borrow is reduced, theoretically more buyers show up, right?
And that
so
could push prices.
Yeah.
But in theory, that also means that more supply could come on because folks
I
feel
see.
comfortable.
If there are more
going-
buyers, then you start to get more building as well.
Well, the building's happening. That's part of it. But there's been a lot of folks that are trapped in their homes because
see.
When you're stuck in a home, that's because it's a 3%
Right, because
mortgage.
the values of homes have remained stubbornly high.
Because nobody wants to.
But the turnover
sell.
is very low, right?
Yes.
Like, so people aren't actually. You've got a very valuable asset on paper that you can't actually unload because
Correct.
the market's not very vibrant because there aren't enough buyers.
Yeah, and
I
the
see.
only way to unload it is to take a home equity line, really.
Yeah.
Right, and those rates are really high.
Right.
And so you'll have probably more of both.
So you would say just on net, and I think this might be common sense and knowledge, but just you're an actual smart economic person. On net, lowering the rates here will help the housing market. It'll increase turnover and volumes and get it hopping a bit more again, whereas right now it's kind of frozen.
I wouldn't call it frozen, but yes.
Sticky.
Yes.
Interesting.
So, I mean, there's dueling things. But again, the focus of the market and the focus of the Fed is really on the employment picture.
Yeah.
And you had a July non-farm payrolls print that was below trend. And you've had, wage pressures that are subsiding. And, looking ahead, basically all of next week, you just keep getting more and more labor data, right? So on Wednesday, you've got ADP, you've got ISM services, which will also have an employment component. You have the job opening figures, that JOLTS that are also released next week, in addition to August non-farm payrolls.
Mm-hmm.
And so the market will have plenty of information about the current state of the labor market, basically by the end of next week.
Mm-hmm.
And, I think expectations have come off a lot. And if you start to see a more rapid deterioration in the labor market, that's when the Fed, will probably be forced to aggress in terms of the magnitude of the cuts.
All right. So that would be, broadly speaking, supportive for risk. Right, if lower rates.
It's really tough to say. I will
Because
tell
also
you. I will tell
equities
you
are like still pretty much at all-time highs.
correct.
So I guess how much more support do we need?
Yes, I would say the most direct impact is in interest rates and currencies.
Yeah.
Right. The dollar has been on the back foot basically since Jackson Hole and a bit before as well. Cable being a really strong outperformer, and euro, I think, got up to as high as like 112 and stuff. And so, and then the BOJ move obviously took dollar yen from, 160s to the low 140s and stuff. So you've had a dollar, which in all essence is just a function of relative rates and stuff, move with the front end pricing. And so those, I would say, are the two markets most directly impacted. On the equity side, if the employment picture is getting worse and if the Fed is responding to a worsening employment picture, like that's bad news is bad news.
Yeah.
Right? Like people will spend less on discretionary items, like consumer discretionary. Companies are already not doing well. Just look at some of these high-flying like fashion brands and the other consumer things.
Right,
Like,
I saw something about luxury watches not doing well. In fact, some newspaper threatened to blame crypto for that, but I think
it's possible. But you are seeing, folks pinching their belts and wallets, and so that has a multiplier effect on the economy. At the same time, companies can now finance debt at cheaper levels.
They can.
Bad companies that have a lot of debt maturing in the next year or two will be able to refinance at lower rates. If you take the a lot of earnings are also outside of the U.S. And so if you see material depreciation in the dollar, they'll actually bring back more revenues to U.S. companies to the tune of about an extra 2% or something to EPS based on the magnitude of this move. So there are parts of the rate move that will help companies, but bad news is bad news when you're at all-time highs already.
Yeah. That's fair. All right, real quick, let's talk about crypto markets, because over the weekend, actually, we were running pretty high. We'll stick to Bitcoin here. Bitcoin ran about as high as almost 65K, I think, maybe.
65K was the high, yeah.
Yeah, and it was doing fine, chugging along, and then basically on Monday, really started to break down, and as we talk now, we're about 59K. I saw us go as low as about 58K again. Shout out Bitcoin 58K gang. Why? This is what on the back of a weak dollar, theoretically at least constructive Fed to something like Bitcoin.
No, I mean, yeah.
What's going on here with the corn, and obviously others performed even worse, but
yeah. So you had a short squeeze that got you up to 65K, and then you had some natural profit taking in BTC. It's also worth keeping in mind that basically a month ago we were at 50K, so there's a lot of buyers that were heavily in the money.
Right, 50. You buy at the 50 low,
you bought at
and
50
you sell
to
at 65. That's a nice move.
That's a nice
In a
move
month.
to capture.
Yeah.
And so folks have done real well. And then you still have GOX distributions that are ongoing, and basically what happened yesterday was in the afternoon, it's literally, the last week of August, lots of folks off desk.
Yeah.
I want to say, I read some stat that this week we had probably one of the most illiquid weeks in the S&P, like in terms of volume wise.
Like what, ever?
Like this year.
Yeah.
And so it wasn't a liquid period. And so you had a sell-off that got exacerbated by liquidations into low liquidity, into dealers that were, basically short about $20 million a gamma at the 60K price point. And so you had $2 billion of OI wiped out, and, short gamma positioning and GOX distributions,
but mostly
into probably one of the most liquid periods of the day and year.
Yep, makes sense. Technical, some overhang. I mean, the GOX distributions you're talking about are from the distributors to their end users and clients,
Correct.
right? Because we've seen, I think, what we expect is, and again, we don't know, but we expect from the GOX estate that all has been distributed now. But of course, that's getting sent to Kraken, BitGo, Bitstamp, whomever over the last month and a half, and at some point they actually give those coins to people. But otherwise, it sounds like I'm mostly hearing a move, a technical move, a profit-taking move exacerbated by market structure. Nothing, doesn't feel like panic out there, does it?
Does not. But I will say that, it is concerning the decoupling from macro that you've had. You're talking about a dollar that's been super heavy over the past couple of weeks.
Which has usually been constructive for
which
Bitcoin.
Is good. But just think about gold, right?
Yeah.
One of
all-time highs.
All-time. I mean, it's off a little bit today.
Yeah, but over the last couple of weeks.
Oh yeah, you're trading at all-time highs in the biggest monetary debasement hedge in markets or
in human history.
Yeah. Right. And then equities have obviously, S&P was within spitting distance of fresh all-time highs.
I think one of them, I can't remember, it might have even been the Dow, but
Dow hit an all-time high yesterday.
One of the intraday all-time high.
Yeah. And so, it is concerning that we've decoupled so much from traditional markets. And, I'd say the other concerning part is just, one of the reasons that people like crypto and like Bitcoin is because of the upward price moves.
For sure. Number go up.
Number go
it's
up.
The best advertising that you've got.
Yeah. And so when you lose that and you don't really have a catalyst outside of Trump starting to do better in the presidential debates and polling, it does kind of leave you with being like,
where do we go from here?
Where do we go from here?
Yeah. Well,
but there's a lot on the horizon over the next 6 months.
Well, we're going to get into that on next week's show because I want to thank you, Beimnet Abebe from Galaxy Trading, for coming on Galaxy Brains.
Thanks for having me.